In this third section of the mentorship, we're going to be talking about top-down analysis. We've got long-term perspective, intermediate-term perspective, short-term perspective with a New York session bread and butter model, and then eventually putting it all together. So let's go to long-term perspective. Long-term perspective, guys. Here we have a nice little quote from the Inner Circle Trader, or ICT. Without the understanding of higher time frame charts, you are gambling, which is very true. So the long-term perspective is the why in why price moves, right? So the long-term perspective, monthly, weekly, daily charts gives us the why. Why should price go up to a specific level and why should price go down to a specific level? We answer the question to why price should move from these time frames, right? All price is doing is trading from one higher time frame premium or discount level to another higher time frame premium or discount level. So what do we need to trade with these time frames, right? We have seasonal tendencies, which is not always necessary, but highly effective when used in combination with higher time frame PD arrays. We need a dealing range and those higher time frame PD arrays. We need higher time frame external and internal range liquidity. We can couple it up with daily SMT and stop hunts, and eventually we'll go into a buy or a sell program. So how do we determine if the higher time frame order flow is on our side? So we can go over a few things. Is price rejecting when going below lows and significantly trading through highs, or is price rejecting when going above highs and significantly breaking lows, right? And think about high resistance liquidity and low resistance liquidity, right? We can spot those with those rejections and easy price movements through engineered liquidity highs, right? Are down close candles supporting price higher or are up close candles supporting price higher? Think about those order blocks, right? Buy side of the curve and sell side of the curve. Are bullish PD arrays failing or are bearish PD arrays failing? With using this, we can also confirm our bias. Seasonal tendencies. Seasonal tendencies are treasure maps to finding low resistance, higher time frame moves when they are aligned with higher time frame PD arrays. So on their own, they don't really mean much, but if you combine it and align it with higher time frame PD arrays, they are very effective. When the seasonal tendencies do align with the higher time frame premium and discount arrays, price is very likely to have a fast and volatile low resistance price swings between one higher time frame price level to another higher time frame price level. When the seasonal tendency don't align with the higher time frame premium and discount arrays, price is more likely to take longer to move from one higher time frame price level to another higher time frame price level. The seasonal tendencies are the 12-month macro laid out in front of you, and we'll show you a chart later how that looks like before the trading year even begins, every single year. So we have those median lines, right? 15 years, 30 years lines, what the seasonal might be doing. Our objective with seasonal tendencies is to blend time, the seasonal tendency, right, and price together, the higher time frame premium or discount arrays. So price meets time and time meets price. So over here we've got a seasonal tendency chart for the US dollar index, and let's focus on January and February, right? Over here we can see they're pretty bullish, right? So we have those lines going up. We have the 33-year line, we've got the 15-year line, and then January and February looking pretty bullish, right? So here we have a US dollar index chart on the monthly. We've got this monthly fair value gap being hit, right? Discount monthly fair value gap. And let's look at how that forms. So we just talked about that seasonal tendency, right, from January and February. Both should be bullish, or at least start to turn bullish in January and February. And when a higher time frame aligns with that seasonal tendency, you can clearly see how that price action explodes to the upside, right? So over here, we still had a bullish seasonal tendency, but you can see price action is just consolidating, right? And we didn't hit that higher time frame PD array yet, which is that discount monthly fair value gap, right? Now, as soon as February starts, we hit that monthly bullish fair value gap, and you can see just in a couple of days, we move way more than we did in the half of this January price action, right? So over here, these three candles keep pushing up, right? And then this whole area, which took a lot of days, 2 weeks almost, and then in a few days we make the same move. So as shown in the previous slide, we can see that even though January has a bullish seasonal tendency, we don't just long because we have a bullish seasonal tendency, right? We need to wait for time to hit price, and price is that higher time frame PDRA, and it needs to align before we get that explosive one-sided price action move to the upside, and that is what we see in February. So back to the dollar chart, right? We've got that bullish tendency. Again, January we did not tap into that higher time frame discount array, but in February we did, right? Breaking structure over here in January, in this move up during February. Displacing up higher, leaving a bullish fair value gap. So we've got a PD array formed where we can take a trade from or base our trade idea from. So we've got a Australian dollar, US dollar monthly chart, right? And let's think about external to internal range again. Keep repeating that, right, for yourself. If you see external range liquidity being taken on a higher time frame, it's highly likely to draw into a higher time frame internal range liquidity, which should be a fair value gap. So pulling up the seasonals, right, we have a bullish seasonal for January and February on the DXY, which means all foreign currencies should go lower, right? So we should have a bearish seasonal in January and February for the Australian dollar because the US dollar has a bullish tendency. Now, after raiding that external range liquidity on the monthly, taking out those buy stops, right? Once we take out that external range liquidity and we are in line with that bearish seasonal, we can see how price explodes to the downside. We have that daily stop hunt, right? And from this point out, up close candles should support price action lower, right? And we can see that over here, price moves up, respecting this area over here, this fair value gap, trading lower and lower and lower until we reach that monthly internal range liquidity. So seasonals, couple it up with a higher time frame PD array. An old high is also a PD array, right? It's a premium area. So we stop hunt over here and then we displace with that seasonal tendency. So again, a reminder, the US dollar index is bullish, right? Bullish seasonal tendencies. We've got that daily fair value gap. So again, back to that Australian dollar, US dollar chart, right? That monthly range buy stops have been liquidated, and now let's look what our dealing range is, right? We've got this range high down into this range low, and then we have a break of structure down here. Equilibrium is around here, so everything above this equilibrium line is in premium. And then if we look at this like this on a daily time frame, we've got that stop hunt up here, break of structure, draw out that premium levels, right? Another daily stop hunt. And if you remember about the silver bullet lesson, right? Intermediate term high has been formed over here, right? So even on the daily time frame, you can spot that silver bullet setup. After we go into bearish order flow, right? After respecting bearish arrays, we should see all up close candles supporting price to go lower. And we can see that over here. Price trades back into that bearish order block. Those up close candles trades lower, forming another bearish order block. Over here, tapping it in slightly, moving down lower. We have another bearish order block, and we keep declining and declining until we hit our target, right? So we go from external back to internal on the higher time frame. So over here we've got a British pound US dollar monthly chart, right? We've got that premium levels outlined over here, right? This little red box, and then the discount levels down here all the way to the low, which should be discount, right? Now, what did we do over here? Monthly premium. Can we spot something else? We've got that mitigation block, right? This should have been a bullish order block which got violated. And now we're using that on the sell side of the curve to look for a monthly premium level. Now we rate those buy stops over here on the monthly and then declining lower. So with that bearish seasonal, right, and a bullish seasonal for the DXY, remember? So if DXY has a bullish seasonal, then all foreign currencies should trade lower, which would be a bearish seasonal for the British pound, US dollar. Now we don't just look for shorts in January because we have a bearish seasonal tendency, right? We need to wait for time to meet price and to meet on the DXY as well, right? So higher time frame PD array on the DXY. Remember in January that fair value gap got hit, and that should be the catalyst to trade down lower. Now, if you're unfamiliar with SMT, it is when, let's say, these highs are not getting rated, right? And on DXY, the lows are getting rated and then continues to move up. This is considered SMT. So over here we got daily SMT with the Euro USD. So over here we are not taking out any highs on GBP USD, and on Euro USD we are presumably taking out those highs, right? Because DXY pushed down into the lows, which makes Euro USD most of the time be in line and take out the highs. So we have some SMT going on over here, and now it is lining up with that bearish seasonal tendency, right? So we don't need to liquidate this high for this to decline lower in February. Zooming in a little bit more, right? We've got those daily external sell stops down here. We've got internal range liquidity down here. Again, after that SMT has occurred, we don't need to go above these highs anymore or this high. So we're waiting for a bearish array to form, which is this fair value gap, right? And it is in premium. That's also important. Now, what are we forming over here? Think about that silver bullet lesson, right? This is an intermediate term high, making it even more probable that we're going to continue lower and lower to eventually take out this sell side liquidity. So from internal range liquidity, what are we looking for next? External range liquidity, right? So from internal to external. Got some more external range liquidity down here, right? Before we go to the extreme target, which is this low down here. So after drawing out that premium and discount level, right, we can see those external range liquidity sell stop has been taken after we formed that intermediate term high. Now we can anticipate a short-term high forming next to this intermediate term high, right? Because this intermediate term high is a intermediate term high because we have a short-term high to the left of it and now a short-term high to the right of it. We're hitting that bearish fair value gap, right? So we have a premium array. If we take this high, this range high to this range low, right? Price trades back into it, comes back one more time over here and continuing that bearish seasonal tendency, hitting a higher time frame POI and then eventually taking out that sell side liquidity. So over here we've got a Nasdaq 100 E-mini futures chart, monthly chart. Now, without knowing the seasonal tendencies, we can still look and see where the higher time frame is most likely to move. Because remember, price is just moving from one higher time frame level to another higher time frame level. So outline the dealing range, right? First of all, this range low to this range high. So we've got our dealing range. We're going to look for daily SMT or stop-ons, and then we can see where we go from internal to external and external to internal, right? So what do we see over here? We've got a monthly fair value gap, right? Internal range liquidity. So where do we want to go next? What do we do after we take internal range? We go to external range, right? So we've got that monthly external range liquidity up here. So we know we go from internal to external and a draw on liquidity without knowing those seasonal tendencies, right? We know where price is most likely to draw into. Now let's look at the weekly structure after knowing what the monthly is most likely to do, right? We've got that monthly discount fair value gap, internal range liquidity, remember? We're going to external range liquidity next, so we know the weekly should be bullish, and without knowing those seasonal tendencies, we can use all the PD arrays moving up into that external range until we liquidate that. So over here, we drop down right into that discount fair value gap on the monthly. Now we have weekly external liquidity, which is over here. So where do we go after we take that weekly external? Your eye should immediately go to internal range liquidity, right? So you look for a fair value gap, which is down here, right? Again, draw out your dealing range, this low till this high. Then we've got that internal range liquidity. Then we can continue up higher. So from internal to external, from external to internal. And once we hit internal, we want to go external once again, right? So we take out this high over here, right? External range liquidity, internal to external. And where do we want to go next? To the buy stops. Right, so over here we've got another example. We've got the Euro Australian dollar daily chart. Now, without knowing seasonal tendencies and using a daily structure, because the monthly and the weekly is unclear, right? We can still go to a daily structure and see where we can find our setup and our daily draw on liquidity. So over here, first of all, external range has been taken. I give you a few moments to see where you are most likely to draw into, right? So where do we go from external? Right, we want to go to internal range liquidity, which is this fair value gap. So draw on liquidity even without knowing the monthly or the weekly, because that's unclear and we don't know what the seasonal tendency is, we can still see internal range to external and external range to internal range can be utilized to still figure out where the daily time frame is most likely to trade into. Higher up in the range, same occasion, right? We have this dealing range low into this dealing range high. What is happening over here? We're creating an imbalance, right? In discount, that's important. We don't want to see that imbalance in a premium level. Taking out this lows down here, creating a intermediate term low, and then continuing up from that discount fair value gap. So using structure on the daily, we can still know where we want to go. We went external, right? And then we go back to internal. And once we hit internal, we want to go external once again, which is up here, right? Putting that I on there. So over here, external buy stops, and this keeps repeating over and over and over again. So external has been taken. So now where do we want to draw into, right? Again, we go from external to internal and then from internal back to external. So internal range liquidity, this fair value gap, and might I just add, we don't know what the weekly is doing, right? And the monthly, and we don't know what the seasonal tendency is, and we can still determine our draw on liquidity this way. Discount fair value gap has been hit. Now where do we go? External once again, right? So from down here all the way to up here, it is all it is doing. It's going from external to external, back to internal, back to external, right? Now that we know how to determine our long-term perspective, let's go to intermediate term perspective. So intermediate term perspective, 4-hour and 1-hour charts. We just went over that long-term perspective, right? The monthly, weekly and daily charts, and now we will need to determine our intermediate term perspective. So the intermediate term perspective gives us the answer to how price should move to get to that long-term perspective draw on liquidity, right? So remember, long-term perspective is the why price should go to a specific level, and that intermediate term perspective is how price will get to that specific level. The intermediate term perspective is how we get to our long-term perspective draw on liquidity. We want to utilize the market structure and PD raise on this time frame to help us get to the draw on liquidity. So the highest probability trades are when these two perspectives align and the order flow is aligned. So long-term perspective and intermediate term perspective being aligned is very powerful. As with everything in trading, our analysis starts with the draw on liquidity, which we determine from our long-term perspective timeframes, right? The monthly, weekly, and or the daily analysis. And after we've determined our high time frame, weekly or daily draw on liquidity, we want to wait for our intermediate term perspective timeframe to break market structure in the direction of our long-term perspective draw, and this aligns both of these timeframes. Using draw on liquidity and premium and discount arrays determined on the long-term perspective, we want to align ourselves with the weekly candles or the open low high close or the open high low close, right? From lesson number 1, that power of 3. We want to determine which weekly profile is likely in the current week. using the economic calendar and focusing on the day with high impact news events for injections of volatility. So over here we've got a gold weekly chart, right? We've got these relative equal highs up here, an easy draw on liquidity. Sell stops have been liquidated on the sell side over here, right? So order pairing again happening over here, starting to trade up, up and up, and back into that discount array, which is this weekly breaker, right? So our premium high is over here, discount low is down here. We've got this weekly discount breaker. Now we've got our long-term perspective, right? So now we want to drop down in a lower time frame to see if our intermediate term perspective is in line with our long-term perspective, and then we can frame a high probability trade, or at least a high probability draw on liquidity. So once we go into that breaker, where do we want to go? External range liquidity, right? Those buy stops are resting above this high, engineered liquidity. We know our longer term perspective is those equal highs over here. And let's dive into a lower time frame to see what that looks like. So we've got this 4-hour chart for gold, right? This is our intermediate term perspective, and we need this intermediate term perspective to align with our long-term perspective. So our long-term perspective is bullish, right? We see those buy stops high up in the range, and now we need order flow to be bullish also on the 4-hour time frame, because then both of those perspectives are in line. Now we can see this sell stop rate down in that. Remember that weekly breaker, right, is down here. Now we have this 4-hour market structure shift, and then we can say, all right, long-term perspective and intermediate term perspective are aligned, and now we are good to go for more bullish price action and bullish order flow. So over here we draw out our weekly opening price, right? We want to know in which day of the week we are trading lower and higher, and does it make sense for us to manipulate lower first on a weekly candle, right, to continue up higher and align that with high impact news events. So let's look at the economic calendar. We've got Monday, no news. So what can we expect on a day without news? We can expect the daily candle to accumulate inside its range, right? So we can clearly see on Monday we don't have too much of a movement, and it starts to accumulate. On Tuesday we've got high impact news, consumer confidence, so this could be a day where we can see some volatility injection, right? And Monday being accumulation, we can expect an expansion to happen on Tuesday, coupled up with that red folder, right? That high impact news. And also notice how we are below weekly opening price over here, right? And running Monday's low. We can expect the weekly profile to be a Tuesday low of the week, and with the high impact news it makes sense, right? So we have that structure shift on the 4-hour, right? So intermediate term perspective lining up with that long-term perspective, and then high probability we have created the low of the week with this news manipulation. Right, so outlining the news events from start to finish, right? Monday, no news. What can we expect? We can expect consolidation or less volatility. Then Tuesday, high impact red folder, right? Volatility injection. So what do we see? Low of the week being created with that high impact folder below weekly opening price and running Monday's low. Those sell stops have been liquidated and order pairing happened over here. So on Tuesday we move up, breaking structure, and then long-term and intermediate-term perspective is aligned, right? We've got that 4-hour structure shift, and then our weekly draw on liquidity is in line. So outlining that low that got raided, right, over here. Sell stops have been liquidated, order pairing has happened. Tuesday, move up. Now Wednesday, we've got another high impact red folder, so we can assume more volatility is coming into the marketplace. We can see this happening over here, right? We have this bullish order block supporting price to continue up higher. Another bullish order block being formed, continuing price up higher. Now, what happens on Thursday? We don't have any news on Thursday, so how does that look like? We have an indecisional day, right? And then at the end of the week, we have another high impact news red folder, right? So another volatility injection over here. So keep in mind, very important, if you're looking for your long-term perspective, your intermediate term perspective has to be in line. And then we look at the economic calendar, right? Which day is it most probable to create low of the week or high of the week, right? So without news on a particular day, you can expect more of a accumulation or consolidation day, right? And then we try to frame our setups on those days with the high impact red folder. So on Friday, you can see actually continuing up into the range, right? With this fair value gap, internal range liquidity, right? Where we're going to external, which is above this high, and we're forming a bullish order block in the process, and then continuing up higher. And eventually we take out those buy stops, right? All the way down from our long-term perspective, that weekly breaker, right? And then continuation up all the way into the buy stops. So after we take that external range liquidity, those buy stops, right? We can expect what? From external to internal, right? So what would be our next drawn liquidity? If you guess that internal range liquidity, you are right, because we go from external to internal. Now, this is counter trend, right? Because our long-term perspective is bullish. We expect price to go higher than this, but with a intermediate term perspective being bearish, the counter trend draw should be correct, because we still have to think about that external to internal range liquidity, right? Now this is our next draw on liquidity, right? That weekly fair value gap. So with this weekly fair value gap being the draw on liquidity, even though our longer term perspective is bullish, but it's switching right now from external to internal. Now we need the 4-hour chart to be in line with our idea that we want to draw into this weekly fair value gap, right? So let's drop into that 4-hour time frame. Before we can be bearish, we need to see that buy side rate, right? We see that buy side rate up here. Now market structure shift happened down here. So now what do we have? We have our longer term perspective, which should be the drawn liquidity in that weekly fair value gap, is in line with our intermediate term perspective, which is that 4-hour market structure shift, right? So drawing out our premium and discount levels from this high to this low, we can see price action moves into that fair value gap up here and then continue down lower. Drawn liquidity still that weekly fair value gap. So outlining that 4-hour premium order block, right? And coupled up with that fair value gap, high probability area for rejection. So that market structure shift on the 4-hour perspective, right? That intermediate term perspective is now in line with our long-term perspective, which is the drawn liquidity in that weekly fair value gap. We can see this premium array, which should be the next area where we can frame our setup. And you see it hits it and then trades down lower. Again, important, look at the economic calendar. What day of the week is it most probable to create high or low of the week, right? So we want to couple up that high impact news with our intermediate term perspective. Now look at the economic calendar. What is happening on Monday and Tuesday? There is no news on Monday and Tuesday, right? So what can we expect? Consolidation, right? Not too much volatility injection, because we've got that high impact news on Wednesday, CPI, right? And then on Thursday we've got PPI, and then closing off the week on Friday we've got consumer sentiment. So expecting nothing on a Monday, no news, no news again Tuesday. Now what can we expect for Wednesday, right? What do we want to see when we're bearish? We want to see a high of the week being formed, right? And then that is coupled up with a high impact news event. So in this case we got CPI, and then it's most likely to form high of the week with that news folder. So CPI, volatility injection, and remember that 4-hour bearish order block, right, in premium, that is the area where we want to trade from. So this is a 1-hour chart, and then we can see we hit that area over here. High of the week being formed, rating Tuesday's high. So buy stops have been rated again. And think about market structure, right? We see this short-term high here, intermediate term high, and then short-term high here. So we're forming a market maker sell model right now, right? Bearish order flow. Another high impact news folder running Asia highs over here. So we want to see that external range back to internal, right? And then we got this external rate over here, order pairing, high resistance liquidity run, because we see an immediate rejection after we take out that high, right? And Friday we have another high impact red folder, right? Volatility injection, making it even more probable to draw into our longer term perspective, which is that weekly fair value gap, right? We got a premium fair value gap over here, we drop or we dip into that premium fair value gap and we still continue our way down into sell side of the curve. In this lesson, we're going to be talking about short-term perspective, a New York session bread and butter model. So we've had that long-term perspective, that intermediate term perspective, right? And now it's time to dive into an actual entry model. So, short-term perspective. Let's think back to the previous lessons, right? That long-term perspective, the why price should go to a specific level. We know how to do that right now. Then we had that intermediate term perspective, right? How price will get to that specific level. And now we're going to be talking about that short-term perspective, which will be our entry for our execution and the trade. So obviously we're going to talk about a specific time window, which is going to be 8 a.m. EST to 12 p.m. EST, and this is the kill zone for this model. And we got to do a little shout out to the currency merchant for the logic behind this time window. So thank you, the currency merchant. The New York session between 8 and 12 is the bread and butter time window of the daily range. It's the sweet spot in the daily candles power of 3, right? That open, high, low close for a bearish candle or the open, low, high close for a bullish candle. Between 8 and 12, price only does two things. We either have a continuation pattern or a reversal pattern. So 8 a.m. EST to 12 p.m. EST is our kill zone. Now at 9 a.m. and 10:30 a.m. EST, usually that is the sweet spot in the kill zone for reversal days, for the reversal pattern. So we'll outline this in the charts coming up and we'll see how that is formed. And then we have 10 a.m. to 11:30 a.m. This is when London was a extremely large range, or we have a red folder at 10 a.m. Now, continuation days. In a New York continuation, we want to have seen London go below or above midnight opening price to accumulate for the daily range, right? So smart money accumulates sell orders above this New York midnight opening price, right? To continue down lower during the day, and vice versa will accumulate long orders below that New York midnight opening price to go for an expansion higher. So at 8 a.m. we delineate a vertical line, and when we look left for failure swings, right? Remember back into the core concepts, we've got those LR signatures, low resistance liquidity runs, right? Failure swings, equal highs, equal lows, trend line, and all that kind of stuff. The only two options for framing a trade between 8 and 12 are premium or discount array retracements or stop hunts. So on reversal days, if we are bullish, we want to buy below the opening price at midnight, right? And if we are bearish, we want to sell above the midnight opening price. So at 8 a.m. we delineate a vertical line and then we look left for those failure swings, right? Those LRLR signatures. Then we think back about core concepts, right? Failure swings, engineered liquidity, equal highs, equal lows, trend line phantom, and all that kind of stuff. Now, what are we targeting? We're going to be targeting previous daily high or low, right? The easiest draw on liquidity, Asia high or low, or London high or low. The only two options for framing a trade between 8 and 12 are premium and or discount array retracements or a stop hunt. So now we also need to know when to avoid New York session, right? So when do we want to avoid New York session? When London is an extremely large range. And why do we avoid it? Because most of the time the daily range has expanded already, and New York session then tends to consolidate or accumulate or go into like a short-term seek and destroy profile, right? There's no juice anymore in the market and targets have been hit already. Also, when we have a red folder later in the afternoon, like FOMC, most of the time that is at 2 p.m. EST, right? And then the day before news events such as NFP or CPI. Right, we've got a crude depiction for our short-term perspective bread and butter model, right? Remember, time is very important, so we're going to be looking for that setup in New York kill zone 8 a.m. to 12 p.m., right? For that continuation or reversal. Now over here, we've got a continuation pattern, and basically what you're looking for is a premium and discount levels. So you draw out your range, right? If you're looking for shorts, you're looking for a premium array, obviously. So that could be a 1 hour or a 15-minute POI. And you can see drawn liquidity over here is lower, and we wait for our price action to go into that premium array and in that specific time zone. That is very important, right? Now, looking for liquidity, very important. We look for those failure swings, right? We can see those failure swings down here, another failure swing down here, and then that smart money reversal happening in our POI. That's what we wait for, and then the setup will form in our sweet spot from 8 a.m. to 12 p.m. Now, what is option 2 in the continuation? So we either hit a higher time frame premium or discount array, right? Or we look for that stop hunt and then continuation lower into our drawn liquidity. So basically we go back to that sweet spot, right? 8 a.m. to 12 p.m. EST. We see structure breaking down. Again, looking for liquidity. We see those failure swings, right? We want to have that low hanging fruit, that easy target. So when we break down, we have a clear draw on liquidity and continue down into those lows, right? We have that stop hunt on the 1 hour or 15 minute, right? So we know we think back about order pairing, right? On the core concepts, we order pair down up here, and then we continue down lower, breaking structure, and then we have that continuation between that 8 a.m. and 12 p.m. time window. Right, let's talk about that reversal pattern. Now, this looks like a market maker buy model, right? We have that original consolidation over here, and also we always draw out our New York midnight opening price, right? Because we want to be a buyer below this timeline, right? The New York midnight opening price, and we want to be a seller above it. So with a market maker buy model, we identified that original consolidation. We've got also those equal highs, right? Or failure swings up here. So we have a clear draw on liquidity for this one. And then we wait for that discount array to happen and that specific time zone. So 8 a.m. to 12 p.m. This is where the reversal can occur. So over here we hit that array, right? The discount array. We break structure up inside the kill zone, and then we're going to be looking for our setup. So same structure over here again, right? Only one difference, it's the time window is extended to the right a little bit further, right? Because then in late London we hit that discount array instead of that New York kill zone time frame. Now this is fine because we can still catch an entry because we wait for that specific time window, right? We know break of structure and a discount array has happened already, so that sweet spot should be hit within our kill zone, and then we still have that market maker buy model which we can complete. Right, so over here we've got a Euro USD 15-minute chart. Now, what do we want to do first, right? We want to delineate our New York midnight line, right? We've got that on the chart until 12 p.m. EST, right? The end of the New York kill zone. So what do we want to do at first? We want to draw out our New York opening price line, right? Because we want to be sellers above and buyers below that, right? We've got that line outlined over here. So we can see price is starting to accumulate above this New York midnight opening price. And why is it doing that? Because smart money wants to accumulate their short orders, right, to continue down during the day. Now, let's think about what time zone this is happening, right? We've got London open kill zone, right, 2 a.m. to 5 a.m. And think about London. London almost always creates high or low of the day unless we hit a higher time frame POI where we can have a reversal, right, during a New York session. But accumulating short orders above that New York midnight open price over here, and then think about order pairing, right? From the core concepts, we've got that order pairing above those buy stops, and then they drive price down lower during the London kill zone 2, breaking structure lower, and then for us we wait for that specific time frame, right, at 8 a.m. to 12 p.m. EST for that New York kill zone. So outlining a vertical line from 8 a.m. and then from this point on we're going to be looking for low resistance liquidity, right? And or we're going to wait for that higher time frame or that premium discount array to be hit, or we wait for that stop hunt, right? So two things: we hit a premium or discount array and then continue our way down, or we're going to wait for that stop hunt. Now, do we have news, right? We need to see, always keep an eye on that economic calendar. We've got 10 a.m. consumer sentiment. So highly likely what we just talked about, right? You want to have that 10 a.m. to 11:30 a.m. as your sweet spot for looking for a setup. If we don't have high impact news at 10, we can do it from 8 a.m. already. So in our specific time frame over here, we wait for either a stop hunt or a premium retracement, right? So what happens over here? We've got that 10 a.m. news, right? Price drives up and does a 15-minute stop hunt, and after that we can look for our setup, right? So this time we did a stop hunt instead of a premium retracement, and we kind of also went back into this fair value gap, right? That's a premium array. So from that 15-minute chart, we dive into that 1-minute chart, right? We've got that 15-minute stop hunt, and again, think about order pairing, right? Their buy stops are paired up with their sell orders, so price drives lower and lower and lower. And from this point out, we want to see all bullish candles being support for lower prices, right? We got that bearish order block formed after we ran liquidity, and then we're going into a sell program, and we can see that over here. It's offering support lower, and then every up close candles, set of up close candles should be supporting price lower. You can see it here over again, right? And just keep outlining this on your chart. And this is every time you can pyramid an entry on these types of candles, right? So we know the sell program is activated. We are in the sweet spot, right, at 8 a.m. to 12 p.m. EST. Now high impact news has occurred. We already had that stop hunt. So if you were to enter on this first order block, stop loss will be above this high, right? This stop hunt. And think back about that market structure too, right? We've got that intermediate term high formed, which should be protected and not get traded back into again. So this is a good area where you can place your stop loss. Now price comes back into it again, turns down lower. We have another bearish order block formed over here. Price goes in it, trades down lower. We got another bearish order block formed, and this will continue on and on and on until we hit our draw on liquidity. Right, outlining a few more. Bearish order block up here, then price drives lower, another bearish order block, price drives lower, another bearish order block, and just keep outlining those bullish candles, right? Right, we've got a USD dollar Swiss franc 5-minute chart over here, and in the previous example we talked about that stop hunt, right, and then continuation into our price action. Now we're going to talk about that discount or premium array that we will hit, and then a continuation in our kill zone, right? So two scenarios. We covered that stop hunt, and now we're going to talk about that premium or discount array. So as always, draw out your vertical line, right, at 12 a.m. EST until the end of our kill zone, which is 12 p.m. EST. We've got our daily opening line, right? New York midnight over here. And again, think about it, right? New York session is our kill zone, 8 to 12 p.m. EST. But we have one advantage when we trade this time zone, right? Because we already know what the London session has done. So London kill zone, we trade lower, creating low of the day over here, starting to break structure upwards, and we've got that LRLR signatures above here, right? So we see clear targets for London kill zone to go up, and hence we create low of the day. So we already have this information, London open, creating low of the day. Now we look for our sweet spot, right? 8 a.m. to 12 p.m. EST, continuation pattern, right? So earlier we talked about that stop hunt, but we cannot see a stop hunt right over here. But we can use discount arrays, right? So first of all, where is our liquidity? We need to know our draw on liquidity before we find our entry setup, right? So we see this LR signature up here, right? Those failure swings up here. And this is what we want to see if we are bullish, right? We want to see low resistance liquidity. So we want a high resistance liquidity run opposed to our buys, right? So over here, where do we have a discount array? We've got this low until this high, right? This is our dealing range. Why is this the low of our dealing range, right? This low takes out this low over here. That's a high resistance liquidity run, right? And then this high takes out this high. So that's how you define your dealing range, right? Discount into premium, and then we have that failure swings above there. Now we're looking for a discount fair value gap or a discount order block. We get one over here, and in the process that we move up from this discount fair value gap, we can form a what? a bullish order block also over here, right? So outline your PD arrays. So we got that bullish order block over here supporting price to go higher, and there's still an opportunity to get in next, right? Because we still form a breaker up here, and that is a second opportunity. It is still inside our kill zone, right? So important, if it's still in our kill zone, we can still look for setups unless we already cleared our drawn liquidity, and in this case we still looked for higher prices, so an entry was still possible. So we just talked about those continuation patterns, right? First of all, we have a stop hunt. And second of all, we can look for a discount array. Now let's talk about reversal patterns, right? So we have continuation pattern, and now we're going to talk about that reversal pattern. So again, two things you can have. You have that stop hunt, right? And then we have a discount or premium array where we can base our trade idea from. So over here, we've got our discount and premium levels, right? From this high down to this low. Again, we take out this low, right? So this is the low from our dealing range, and then we take out this high over here, and then we have our whole dealing range. Now we drop down back into discount of this whole range, and notice what happens down here. We've got that 1 hour stop hunt in discount of this hourly range, right? So this makes sense. Scenario number one, again, stop hunt, and now we'll dive into a lower time frame to see if we can frame our setups in our specific time frame, right? At 8 a.m. to 12 p.m. EST time frame. Right, so if you're a 5-minute time frame, right? As always, we see where have we had a stop hunt. On the 1 hour, we had one down here, right? So we know order pairing happened over here, and it's likely to reverse. Draw out your daily opening price line, right? New York Midnight. As always, we want to be a buyer below this line and a seller above that line. So with London session slowly trading lower and lower, still accumulating, and notice where the liquidity is resting, right? We've got that equal highs up here. We got this equal highs up here. So we have a nice draw on liquidity to go for a bullish reversal. Now, after that stop hunt, what are we looking for? Our specific time frame, right? 8 a.m. to 12 p.m. EST. Outlining those buy-side liquidity once again over here, London highs and Asian highs, right? We target either previous daily high or previous daily low, or we're gonna do those London highs or London lows or Asia highs or Asia lows. Vertical line on our 8 a.m. to 12 p.m. time zone, right? That sweet spot for the bread and butter setup. Now again, hourly stop hunt down here, right? And then we continue up higher. Now think about, we talked about time earlier, right? What is the sweet spot for a reversal? That 9 a.m. to 10:30 a.m. is the sweet spot for those reversal days. And you can clearly see over here also, we start that reversal with that stop hunt. It's right on the dot on 9 a.m. And then in this time frame, 9 a.m. to 10:30 a.m., we can spot our entry model. Draw out your discount arrays over here, right? So we've got this nice bullish order block formed after that stop hunt. So a high probability order block has been formed over here. We're inside the sweet spot. We displace up higher. So we're leaving behind a fair value gap. That's entry number one, right? Then another displacement, another fair value gap. And in the process, we're creating an order block here too. So we can see these highs over here are relatively equal, right? Is a failure swing, so a low resistance liquidity run up here, right? So with this bullish order block being formed, there was still an opportunity to get in because we did not take out this high, nor did we take out this high, right? And then eventually our longer target was up here. So this bullish order block was another opportunity to get in, and in the process of taking out this high, we form another bullish order block, and that is actually the third entry you can find to continue up higher into the Asian session highs. So small little recap, right? 1 hour stop hunt, we went to the 1 hour chart, and then we look for that specific time frame. Then we wait for a break of structure and those bearish arrays to get disrespected and the bullish arrays to get respected. And we can clearly see that over here, that bullish order block, bullish order block, bullish order block, and we keep continuing up until we liquidate all those session highs, right? London session high and Asian session high. So over here, we've got a Euro USD 5-minute chart, right? It's naked, right? We're going to add some lipstick later, but always we start off with that New York midnight opening line. Just keep repeating that over and over again. Always draw that out, and then end of our New York session kill zone, right? 12 p.m. EST. Draw out your New York midnight opening price, 12 a.m. EST. You can see London slowly accumulates below market price over here, right below that daily opening line, and then we continue up higher, taking out those relative equal highs at the start of the true day open, where the algorithm starts its day, right? And then we're talking about reversal patterns today, right? So that 8 a.m. to 12 p.m. Sweet spot, our kill zone, and we're going to be talking about what happens over here. So what do we want to be targeting, right? We're always looking for those failure swings, those engineered lows, those engineered liquidity highs. And in this occasion, we're looking for a bearish reversal during New York session. So we're going to be looking for failure swings on the low side. And we can clearly see we've got some failure swings down here. We've got some failure swings down here. And eventually we target again, previous daily highs or low, London session highs or lows, or Asia session highs or lows. So we're going to be targeting that London session lows, and then we have more liquidity inside this range too. So it's setting up to be quite a nice reversal. Now, outline that 8 a.m. to 12 p.m., right? Our kill zone, and a reversal should happen inside this kill zone. And time is very important. We're not going to look for a setup before 8 a.m. and we're not going to look for a setup after 12 p.m. Again, remember the sweet spot for reversal days, right? 9 a.m. to 10:30 a.m. Unless there is a high impact news event, right? That if there's a news event at 10 a.m., we don't look for this reversal at 9 or 10:30. We wait for news to pass and then we look for that setup at 10 a.m. to 12 p.m. But right now we have no high impact news and we're looking for a premium array, right? So we discussed the stop hunt earlier and now we're gonna discuss this premium array trading lower. So you can see a break of structure above daily opening, right? We are above daily opening price. We are in the kill zone, 9 a.m. sweet spot for that reversal day. And then we can see break of structure down here. We see in the process of breaking down, we see this bearish order block being formed and a little fair value gap down here also being utilized as support for price to go lower. And then in the process here, we form another bearish order block and price are very willing to trade lower, and you can see this displacement is pretty significant, right? And we go straight for these lows down here, which we identified earlier, right? And eventually we take out those London session lows, which is the drawn liquidity, and this is just a perfect setup for that 9 a.m. to 10:30 a.m. reversal day. So we're going to be talking about how to trade high impact news releases, right? So trading the news events and knowing when to get in prior or post the news even is crucial. So the understanding of news and the volatility injection is derived from understanding order pairing, and we went over order pairing in the core concepts, right? So in a bullish scenario, if we are bullish and the market has taken significant sell stops prior to that news session, then the news will immediately move in one direction higher to pair the orders with the existing buy side liquidity, those buy stops, right, engineered prior to the session. And if we are bullish and the market is yet to take significant sell stops prior to that news event, then the news event will have a fake move. Then they will call that a Judas swing, right, to run those sell stops in the marketplace in the form of external range liquidity low or external or internal range low, accumulating the necessary sell stops to then reverse the market, taking it higher to pair those orders with existing buy side liquidity, those buy stops resting at the marketplace at that time. Now in a bearish scenario, if we are bearish, inversed, right, and the market has taken a significant buy stops prior to those news session, then the news will immediately move in one direction lower to pair the orders with the existing sell side liquidity, those sell stops engineered prior to the session. If we are bearish and the market is yet to take significant buy stops prior to the news event, then the news event will have a fake move, right? That Judas swing once again to run those buy stops in the marketplace in the form of an external range high or an internal range high, and then accumulating the necessary sell stops to then reverse the market, taking it lower to pair those orders with existing sell side liquidity, those sell stops again, resting in the marketplace at that time. So order pairing at a news event, there are three scenarios we can look at. We have that continuation, we have that Judas and then continuation, or we have a complete reversal, so we have a Judas reversal. So over here we've got a schematic of that continuation scenario, right? We've got our premium and discount levels. Going over here, looking where the liquidity is resting, right? We've got those engineered liquidity over here, failure swings, more failure swings, and we're forming a market maker buy model in this scenario, right? So sell stops have been liquidated over here and down there. Smart money reversal down here. And then let's look, when is that news event, right? We've got that 8:30 or 10 a.m. news folder, and then we look for, did sell stops get rated prior to the news? If yes, then it's highly likely the news will just go one direction and shoot up, right? And we can see that over here. We already ran significant sell stops before that news release, and we have engineered liquidity above market price, right? So it's highly likely price will just continue up and take those buy stops and not go down once again. So this is a continuation scenario. So with that news event coming up at 8:30 or 10 a.m., right, that red folder, they want to pair up their sell stops with the buy stops from willing buyers above market price, and we can see that over here, because those were those failure swings, right? Over here, also those failure swings. And remember, all those sell stops have been liquidated already, right? So price has no business to go down anymore, and we're gonna look for those buy stops to pair up the sell stops. Now, this is a 10 a.m. scenario, right? Let's say at 8:30 a.m. we did not run significant sell stops yet. What will happen first, right? We get that Judas and then continuation scenario. So first of all, we talked about that continuation scenario, right? Does significant sell stop have been taken yet? If yes, then we have a one-sided direction with the news release. But at 8:30 and there are still sell stops to be have, then we can look for those sell stops. So there will be a fake move coming up with the news release, and we call that a Judas swing, right? So with 8:30 having a Judas swing, taking out sell stops, and then it's ready to continue up for those buy stops. Same over here, only inverse, right? A sell scenario. We've got this continuation pattern over here, and then we see our discount level here, our premium level up here, and then we are going to spot liquidity first, right? Where are the failure swings? Where are the equal highs or lows? Where are the trendline phantoms? And we can see those are formed here. So we have a basket or a liquidity pool of sell stops down here for order pairing, and then we have those buy stops rated over here, and then we were reversing before news event. So we already liquidated those buy stops before that news event, right? So highly likely we're gonna see a continuation lower one-sided. So this is again scenario one, continuation, because we already have liquidity taken prior to that news event. Now for that bearish scenario, let's say 8:30 a.m. is high impact news and we did not rate some significant buy stops, right? So what is most likely to happen? We can get a Judas and then a continuation, right? So we have over here a Judas swing with the 8:30 news event, and then we get a reversal. So we have a Judas reversal over here, right? So we're going down, we're going up from this 8:30 news event, reversing down, taking all the buy stops, and then we're continuing our way down into the real area where we want to go, which is that liquidity pool of sell stops down here. Right, over here we've got a E-mini Nasdaq 100 futures chart, right? And think about the core concepts again, right? We're dipping into a internal range liquidity pool over here, which is a daily fair value gap. So after internal range liquidity has been tagged, where do we want to go? Right, we want to go to external range. So we're looking from internal to external. So that's step number one. Now we're thinking about time frame alignment too, right? We're looking for a daily external range. So we went into a daily internal range, and now we want to go to a daily external range. And what do we use with our time frame alignment? Daily structure, and then we go into a 1 hour time frame, right? So over here we've got that 1 hour time frame, right? Outlined below down here, we've got that daily fair value gap, right? That internal range liquidity. Next up, we're gonna spot our engineered liquidity or failure swings, right? We've got a bunch of failure swings up here. So there's a lot of liquidity here, right? For the buy side. We've got sell stops down here, we've got sell stops down here, and here, and here, and these sell stops all got rated prior to that news release, right? Because we're gonna zoom in a little bit more later, but this all happens before that news release has happened, and we hit that higher time frame POI, right? So Let's go to the next one, which is a 5-minute chart. So again, time frame alignment, right? We go from a daily PD array into a 1-hour structure, and then we can zoom in from our 1 hour into a 5-minute, and then we have an even more clear picture to get in on a trade, right? So prior to that news release, we've got this CPI over here, right? High impact news. But what happens before that news impact, right? We already took out sell stops here, those sell stops down here, and then those sell stops down here. And then more importantly, we hit that discount array, right? Internal range on the daily. Now we want to look for that external range on the daily. And with all these buy stops being engineered prior to that news release, it's highly likely we have one-sided continuation with news release, right? So like this, you can anticipate price action to go one-sided, or that we have a Judas swing before that news release happens. Now, I do not advise trading CPI because you can get slipped very hard. So this is just an example. And again, I don't advise trading CPI. We've got those buy stops up here for order pairing, which makes sense, right? There's no order pairing anymore down here because we already took out those sell stops prior to that news event, and all that engineered liquidity has been taken out with that news release. Right over here we've got a crude depiction of market structure, right? So what does our eye go to first, right? We're looking for low resistance liquidity, and we're gonna look for old highs or lows which are being ran before the news release, right? So let's see, where is the liquidity? We've got this very clean trend line, and your eye should immediately go there, right? This is all the low resistance liquidity being formed prior to that news release. Now, after this has been formed, what did we do after? Right? Buy stops have been liquidated, right? So now we're gonna see at what time is the news release. Was this news release before we took out these buy stops or after, right? If we have news release after we take out those buy stops, it's highly likely again to be a continuation, right? A one-sided direction with news release, because order pairing already happened up here, so their price has no business to go down, and we have massive engineered liquidity down here, so it's highly likely news will push price down and then liquidate all that low resistance liquidity. Now, if we have 8:30 news before that buy stops have been liquidated, right, then it's highly likely we're going to get a fake move first and then a continuation after. So think about it, right? Is liquidity being liquidated, or are buy stops or sell stops being liquidated after or before that news release? And then we can think about, is it more likely we have a continuation, or is it more likely we're going to get a fake move first and then a continuation? So how does that look like on a British pound US dollar chart, right? We've got that daily chart over here, and again, external range liquidity, right, over here. So what is more likely to happen after we take external? We want to go to internal, right? We have some internal range liquidity down here, pushing price lower and lower and lower. We've got now a failure swing, right? And then the displacement happened down here. So we've got internal range liquidity on the daily. And now let's zoom in a little bit more. Right, we got that 1 hour chart, right? Now we're in a higher time frame POI, right? So this daily fair value gap is our area where it's highly likely that price will move down further, right? Continuation. Now let's look at where is a news event. We have that 9:45 a.m. red folder up here, and then we have to decide where has liquidity been taken already and what is more likely to happen. Are we going to have a continuation lower with news, or are we going to run buy stops first? So if your eye went to this high over here, that is very nice, because then we have an external range liquidity rate, right? So we have a fake move first, taking out those buy stops, because those buy stops have not been taken out prior to that news release. We can see that fake move up and then a continuation down lower, completing that market maker sell model eventually down here. And think about, we're coming from a higher time frame daily fair value gap, right? And if you think about the daily time frame again, we already had those buy stops ran on external range and then displacing down lower. So this is the highest probable PD array to go down from. So those buy stops have been liquidated. And then if we dive into the 1 minute time frame, we can see even a more clear picture, right? So think about that high that got liquidated on the 1 hour, right? It's also still inside a 1 hour fair value gap. We can see price action goes up above it, and then we're breaking structure down here, and you can see this first premium array is being respected, right? We have this breaker and then this fair value gap here. Price breaks down even further and then starts to accumulate before that news release. So we've got PMI, right, at 945. You can see this little fair value gap here offering resistance for price. And again, we already ran those buy stops, right? So order pairing happened already above market price. Now we're going to look for order pairing below market price, which are these sell stops for order pairing into buy stops. And then where is the liquidity, right? We've got these failure swings, right? So engineered liquidity, trend line phantom. So it's highly likely price action will just continue down with that news release because we're already ran buy stops before the news. Right, so over here we've got an execution picture, right? Those execution, there's a lot more execution, but we're gonna focus on this piece over here, right? We just looked at the 1 hour chart and we got that high over here, which is this high, which get ran, right? So those buy stops got run, and you can actually see a sell execution just prior to that news release over here has been activated, and then going for those sell stops, right? So this is a perfect scenario where you are aware that buy stops have already been ran, and it is highly likely this high impact news release will just drop price, and you can clearly see here that sell execution into those sell stops for order pairing and closed down here. So perfect trade. So over here we've got a New Zealand dollar, US dollar daily chart, right? As always, we're going to look at the PD arrays. Where are we in premium or discount, and what is more likely to happen? Are we going to trade lower or higher? So we are spotting some failure swings down here, right? And it looks like we're going to go bearish because we're respecting the daily fair value gap up here, and we're respecting this new daily order block, right? So zooming in, again, time frame alignment, right? We go from a daily PD array into a 1 hour structure. So we're looking at this 1 hour structure over here. Price goes into the daily order block, respects it, pushes down lower, leaving equal lows down here, right? And then we see this little swing high over here. So when we're talking about two news events, right? Let's say you have a high impact news event at 8:30 a.m. and then you have another high impact news at 10 a.m. and you see that 8:30 a.m. news event runs buy stops and then continues to decline. You can anticipate that next news event to continue its way down because we already, remember, took out those buy stops, right? So the first news event, we took out those buy stops, and the second news event, it's highly likely we're going to have a continuation. So you can actually position yourself after that first news event into the second one, and I will show you some executions later. So over here, we've got that 8:30 news, right? Buy stops have been ran. You wait for that news release for price action to show its hand, what it wants to do. Do we run significant buy stops? Yes, we do, right? We took out these buy stops and then started to decline with displacement. And then 10 a.m., we've got that news event down here. So it's highly likely this fair value gap prior to the news event will stay respected and then continue down. And it looks something like this, right? Bearish order block being respected. Think about all those up close candles, right? They should support price lower once it is in a sell program. So that happens over here. Bearish order block, price rejects it. Another bearish order block, price rejects it. Another bearish order block, and that is prior to that news event, right? We displaced lower, and then you have that fair value gap down there. And this is what it looks like with execution, right? We see this buy stops have been ran over here. Price drops lower, 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 lower. This is prior to the news event. So if you have that knowledge, is there already buy stops ran? And is it more likely that we have a continuation with news or a reversal or a Judas swing? And in this occasion, we know buy stops have been ran already, right? And then this is not even risky. This is just logical thinking. And we can see this drop down here, executing, taking a partial, and then eventually closing down at this low. Perfect trade once again. Right, we've got a British pound US dollar monthly chart, right? So we're looking for that monthly draw on liquidity, which was that internal range liquidity here, right? We're going to be talking about that news reversal right now. So now, earlier we talked about that continuation and that Judas swing into continuation, right? And now we're going to talk about that news release. And now we're going to talk about that news release that will be a full-blown reversal, right? So monthly drawn liquidity, that fair value gap. Let's go into a lower time frame. we've got that daily chart right now, and what is price action doing? We're supporting over here, right? And then NFP release is on this day. So our drawn liquidity is that monthly fair value gap, remember? So go back one more slide. We are aiming for this monthly fair value gap. There is a daily order block supporting price prior to that NFP release, right? That high impact news release. And then we zoom in into the 15-minute time frame. So over here, so where is the market at prior to that NFP news release, right? It is in a premiums when we are bullish, so it's likely to reverse, right? Then there are failure swings below us too, right? We've got these failure swings down here, right? And then it failed to run significant sell stops prior to that news release, right? So it's highly likely we can see a reversal from that news release. So market will seek discount and sell stops at the release before reversing and pairing those sell stops up with the engineered buy stops above marketplace. Our NFP news candle is over here, right? And we can see it drops straight back down, taking out all those failure swings, right? And then a full-blown reversal will happen because we hit that higher time frame POI, and then finally we take out those sell stops, right? Because remember, if we didn't take out any significant sell stops, it's highly likely it will reverse afterwards and take those sell stops. So at NFP release, the market is in a premium when we are bullish. So what is more likely that it will do? So if it's in premium, it's more likely to drop back into discount with the news release, right? But there has to be failure swings below us, which is the case in the previous chart, right? And then it failed to run those significant sell stops prior to that news release. So the market will seek discount and sell stops at the release before reversing, and then pairing those sell stops up with those engineered buy stops above marketplace. Over here we have some more lipstick on the chart, right? We've got that discount into premium range, right? Before the news release, where is market price at, right? We're in this discount levels, right? Because the news release is over here and we are still in this premium area, so it's more likely to draw lower. Are there any significant sell stops being taken yet? No, they are not, right? Because we've got all these failure swings down here, failure swing here. So it's highly likely NFP will continue down into those sell stops before reversing. So now we accumulated those significant sell stops, right? We have order pairing below it after that NFP release, dropping down into the daily discount order block, and then over here we can see order pairing happening and then continuation up. So how does that look like on a lower time frame, and can we even trade this, and is there an opportunity to get in to go for those to go for that monthly drawn liquidity, right? That monthly fair value gap. Yes, we can do. We have some buy stops over here, right, for order pairing. So there are engineered buy stops up here and engineered buy stops up here, and eventually above here, right, that monthly fair value gap, which is the drawn liquidity. Dropping into the 5-minute time frame, we see those buy stops for order pairing are present. We hit that discount array, the daily order block, right, after that NFP release, and remember we took all those significant sell stops, right? So over here we're starting to break structure upwards, and then from there on out you want to see all those discount arrays being respected again, right? So we have that fair value gap over here. The bodies of the candles are respecting this fair value gap, and you can actually see it pushes up further and further and further, and then leaving this mitigation block up here, and then price finds support over here on that mitigation block, continuing up higher. And if you can spot it, we've got that new PD array, right? That redelivered rebalanced candle here. So this area over here doesn't go into this fair value gap anymore, right? We know now why is this a breakaway gap, right? Because there's a balanced price range over here already, and we can see price continues up higher and higher and higher, and then dipping one more time into this fair value gap to continue up, taking out all those buy stops for order pairing. Outlining that order block over here, right, where price action can go up from further. We've got that breaker block, or actually a mitigation block over here where price finds support. Another mitigation block up here, right, with a fair value gap. So we have coupled up these PD arrays with each other, highly likely to reject and then continue its way up. So we're coming up into our final lesson of the top-down analysis section. We've had that long-term perspective, intermediate-term perspective, and that short-term perspective with that bread and butter model. And now we're going to blend it all together and putting it all together. So let's put it all together, right? Long-term perspective, higher time frame, monthly, weekly, and daily charts, intermediate term perspective, 4 hour, 1 hour, right? And then we want to do that short-term perspective, 15 minutes down to the 1 minute, and we're going to see how we're going to do that. You've got this crude oil daily chart, right? So we're on our long-term perspective right now. Now look at this chart, what has happened already, right? Think back about those core concepts. We have that external to internal range liquidity, right? So draw out your premium and discount levels, right? From this high up here into this low down here. We have discount until this equilibrium level, this 50% level of the range, and we're going to be aiming from external to internal, right? So where's that internal range liquidity? We've got that daily premium fair value gap, and this is our draw on liquidity. So we know on a long-term perspective, sell stops have been liquidated already, order pairing happened down here, and now we want to draw into internal range. So draw on liquidity has been determined and sell stop rate has happened already. So now we're going to dive into that intermediate term perspective, right? You want to have your long-term perspective in line with that intermediate term perspective, so you have a higher chance of being on the right side of the market, and eventually we go into short-term perspective to see how we can enter on a trade, right? So over here we've got that 1 hour chart for oil. We know from the daily time frame we already ran those sell stops right down here. Now we're breaking back up, and up. We're looking for liquidity, right? We've got this high up here, we have this high up here, and then we have that internal range liquidity for our long-term perspective, right? That's the draw on liquidity. So when does the intermediate term perspective go in line with our long-term perspective, right? We want to have that one in bullish order flow as well, because we want to go into a premium array, and then for that we need a bullish order flow. So we wait for a break of structure on the 1 hour, right? So over here we've got this last swing low which has been liquidated up here, and then we have that break of structure. So we're going into a buy program from here on out. So intermediate term perspective is now in line with our long-term perspective. We can see down here we've got this discount 1 hour fair value gap, right? So we have our POY on the lower time frame, and we're going to be focusing on that 8 to 12 p.m. or 8 a.m. to 12 p.m. time window, right? That bread and butter setup. We only need to know, are we into a continuation pattern or are we in a reversal pattern? That's it. So diving in on a 5-minute time frame, what do we see over here? Take a look at this chart just for a bit and think about what we already learned in all those lessons, right? So our long-term perspective is in line with our intermediate term perspective, right? What are we going to look for next? Low resistance liquidity, right? Because we want to go into the market price where it's easy to go and not high resistance. So over here we've got this beautiful equal heights or failure swings, more failure swings over here, more failure swings over here. So once we hit that higher time frame POI, or from our intermediate term perspective, right, that 1 hour fair value gap, then we have some clear targets where we can trade into, right? So London session highs is our drawn liquidity for this chart. Draw out your New York midnight opening price as always, right? And we want to be a buyer below this opening price, and we want to be a seller above it. Important, now we're going to go into that short-term perspective, right? We're waiting for our high probability time window, which is that 8 a.m. to 12 p.m. window, our bread and butter window. So we're aiming for a reversal, right? Because we are waiting for a drawn liquidity higher. Price action had been bearish for the longest time on the daily, and now is reversing after taking out that external range liquidity, and we want to go into that internal range liquidity, which is that fair value gap on the daily time frame. Remembering back the 1 hour time frame, now we're in line, right? We have that break of structure on the 1 hour, so intermediate term perspective is in line with long term, and now we're looking at that short term perspective. Is the market giving us an ability to go up, right? We wait for that break of structure on the lower time frame too, after that higher time frame target has been hit at POY. So failure swings, right, as outlined earlier, all the way above here. So a lot of buy stops resting above here. So we have clear targets for our window, and we're waiting for a reversal, right? So actually from 9 to 10:30 is that sweet spot for that reversal, right? We got that 5-minute structure shift. So now we have everything in line, right? Long term, intermediate term, and then that short term perspective is in line right now too, because we're breaking structure upwards, right? So all the time frames are in line, and now this gives us the most high probability trade setup you can get. Draw out your discount arrays, right? Where do we want to enter, right? Where is it logical for price to retrace back into and then continue up? We've got this bullish order block formed over here, right? Fair value gap entered on. This is opportunity number one, right? For an entry inside the time window, right? Still inside the time window, and draw this out in time. We still have a bullish order block formed over here, and price keeps continuing up. This is outside of our time window, but we still have not met these London session highs, so we can still draw into this London session highs. But I would keep my entry inside this time frame for consistency reasons, right? Because if you take entries outside of this time frame, right, your data may be skewed because you're taking entries outside a specific time window. So multiple entry possibilities. You could even pyramid in over here again until we reach that level. Draw out your mitigation blocks, right, from the sell side of the curve, as we learned in the core concepts, right? Those mitigation blocks over here, and are they in line with those fresh PD arrays being formed on the buy side of the curve? Yes, they are, right, because we had this bearish order block down here, which becomes a mitigation block once we go into the buy side of the curve. We've got a order block formed in line with that mitigation block. Over here, same situation, right? Mitigation block formed inside this fresh PD array, which is a fair value gap, and then keep doing this until you reach your target, which eventually is those London session highs, right? Failure swings have been liquidated, and this trade is successful. Right, so over here we've got a US dollar, Canadian dollar weekly chart, right? As always, we start off with that long-term perspective, right? We go from long-term to intermediate term to short-term to frame our bias and setup. So with this long-term perspective, what did we do? We have this premium high into this discount low. Where is a premium level? We've got this fair value gap, right? So we're going from internal to external this time, right? So internal range liquidity to external range liquidity. Now, after we hit that internal range liquidity, where should your eye go, right? We've got that external range liquidity down here. And also notice, right, after we hit that fair value gap fully filled, right? Look at the expansion of that weekly candle, right? So after hitting a POI, it's highly likely to expand with more volatility. Now we want to go from internal to external range liquidity, right? And think about time frame alignment. So we're going to dive a little bit deeper into the lower time frame to see our structure form. So over here, we actually have a 4-hour structure, right? We've got a market maker sell model forming with our original consolidation down here with external range liquidity, those sell stops, right? We wait for a break of structure. So our intermediate term perspective is in line with our long-term perspective. We can see those buy stops ran up here, right? And then we form a high probability order block in the process, right? So order pairing up here for accumulation of short positions from smart money. We're breaking down structure, leaving that high probability for our order block behind. And you can go back to the core concepts about order blocks, and we use this same example right over here. So we've got a 4-hour mitigation block here. Why is this a mitigation block? Because this was a prior bullish order block, right? So we can use this old area of buying into our new area of selling, and that's where we can find another opportunity if we dive into the lower time frame. So now we're going to a 15-minute chart, right? And remember that old area of buying, right? That bullish order block to the left of our chart. We outlined that in time to the right, right? And over here, we can see a new area of selling occur. Now, what do we wait for? We either ask ourselves, is this more likely to be a continuation or a reversal, right? So what do we wait for? We wait for our time window, right? That 8 a.m. to 12 p.m. time window, that bread and butter window. Draw out your New York Midnight opening price as always. Never forget this. Always draw this out on your chart. We can see accumulation of short orders above marketplace over here. And then is there any significant buy stop or sell stop ran already? And is there a new target do we have? So asking yourself continuation or reversal, what is more likely to happen in that 8 to 12 p.m. or 8 a.m. to 12 p.m. time window is the only question you need to answer for yourself. So continuation or reversal. Why is it continuation? The weekly reached up into a premium internal range liquidity, right? That fair value gap, and we could see it draw lower later, and the market hasn't reached for that external range liquidity yet. So this is the why for a continuation. So do we have news? Yes, we have 8:30 a.m. high impact news, NFP. So if it's continuation, did London accumulate above opening price? Yes, it did, right? As we outlined earlier. And if it's continuation, what are the two options? We either have a stop hunt or we hit a premium array. So we just asked ourselves, are we doing a reversal or is it more likely to do a continuation pattern, right? So with that 8:30 high impact NFP news folder, right? Is there any significant buy stops ran over here? Not really, right? So we wait for that news folder to be released. We can see this high over here has been liquidated. 15-minute time frame stop hunt. So we have two options, right? Always look for either a stop hunt or a premium or discount array to be hit. And now we have this stop hunt and trading down back lower. And in this occasion, all up close candles should support price lower, right? So we have these up close candles up here. And you can actually see our opportunity lies after that news release, right? After that stop hunt inside this bearish order block, and we break down structure here. See, so this 15-minute time frame breaks lower, this candle breaks lower, and the next candle dips back into that bearish order block. So going into the 5-minute time frame, short-term perspective, right? Now we know long-term perspective. We go from internal range liquidity to external range liquidity on that weekly time frame. On the 4-hour, we have that high probability order block, right, pushing price lower, and then that old area of buying, which we are in right now, which is our new selling area. So that 15-minute order block is over here, which we outlined in the previous slide, right? So that should support price lower, and then we had that break in structure, and this next 15-minute candle we can see here on the 5-minute time frame comes back into that order block and starts to distribute lower, and then this order block is supporting price lower and it just drops through it too. Now we have a breakaway gap. So why do we have a breakaway gap? Think about that new PD array, right? That redelivered rebalanced PD array. So we have a BPR down here, right? Again, because down, up, and then the next candle goes down. So we have a balanced price range up here. So this fair value gap should never get tagged anymore until we reach that external range liquidity, right? Outline all your bullish up close candles, those bearish order blocks, right? We have a bearish order block here. Price moves down, forming another bearish order block. You can see beautiful, these wicks tap into that order block and drop down further. We have another up close candle, and price is being used here as a resistance once again. Back to that 4-hour, right? We had that beautiful market maker sell model, and there are multiple opportunities to get in, right? We have those mitigation blocks where you can get in. You can get in on that high probability order block, right, over here. And then as long as your long-term perspective and your intermediate term perspective and your short-term perspective is in line with each other, it tends to have a very, very high probability for a successful trade setup. And also important, right, time, that 8 a.m. to 12 p.m. window, very important.